Everybody, good morning. Thank you so much for joining this webinar. Okay, great. I think we can begin the webinar for the day. So once again, good morning, everybody, and thank you so much for joining us in this webinar. I am Aishwarya Mahesh. I work as an investment strategist at ithought, and the agenda in this session that we're going to be discussing is some of the trends and mistakes that we have noticed, in HNI investing, and especially in a volatile market that we have been experiencing recently, right? So what I want to clarify in the beginning is that the mistake is usually not, say, lack of intelligence or lack of access, lack of even capital for that matter. Usually HNIs have more of all of these compared to an average investor, right? But yet, despite having all of these advantages also, many still end up underperforming their own potential because of one very deep human challenge called behavior, right? When markets are rising, the investors feel more confident than they should, right? And when it becomes volatile, that confidence quickly turns into, say, anxiety or hesitation, or sometimes even decisions that they may regret in the future, right? Now, what makes this costly is that the right kind of wealth creation is not about just selecting the right product. It's equally about staying invested through the right cycle, asking the right questions at the right time, and also sort of resisting emotional decisions at the wrong time, right? And that is where even sophisticated investors or those who have more access than others can make mistakes which may not be visible immediately to the naked eye, but they become extremely, extremely expensive over the years, and it just hampers the compounding and your wealth creation, right? So in today's webinar, I want to take you through three broad things. First, what the current market environment is really telling us. Second, how investor behavior tends to change in volatile periods and what traps to avoid. And third, how to think about portfolios, allocation, and strategy in a way that helps investors recover that confidence and make better long-term decisions. And we'll also tell you what we did for our investors in such a volatile environment and how they benefited from it. So please feel free to put all your questions in the Q&A box or the comments section. I'll be very happy to answer them towards the end of the session. So quickly moving on. So current market backdrop, what does it look like, right? This is a very simple slide, but quite important, right? We see that India is still in a strong growth phase, and of course, markets are reacting faster to news, and we are hearing and we are seeing how the volatility is continuing. And four is that it is very imperative that in this market, you are a bottom-up investor rather than a top-down investor, right? These are not disconnected thoughts, but rather a part of the same investing reality that we're all facing today, right? So when we say India is in a strong growth phase, we are talking about the structural story and not a straight line market move, right? Of course, the country sort of continues to benefit from the formalization. We've had recent good budget news, financialization of savings, infra, etc. But we are also seeing a lot of volatility. So given these benefits, it means that over a longer term horizon, India does remain one of the most compelling growth stories and growth markets globally. But strong growth just at the macro level does not mean that every company or every stock will do well, or that every quarter will be smooth, or that every segment will remain expensive forever, right? That distinction is very important to make. The second point is that markets, of course, are reacting faster to the news. We have seen this time and again, especially in the last 1 month, right? Earlier, there used to be some lag between an event occurring and the interpretation by the investors, right? Today, the way that information is transmitted, processed, and traded, it's almost instant. It's almost in seconds, right? So management commentary, geopolitics, interest rate signals, currency movements, etc., it can create very sharp reactions within just hours of the event even occurring, right? And this speed sort of creates an illusion that one always has to act immediately, otherwise they will lose on. But most often than not, reacting this fast to any such event is not the same as thinking clearly. And that's what most investors sort of fail to understand. They think that if they have reacted and they have sort of made a move in this sort of a market, they are successful. But that action that they have done comes out of not thinking very clearly and end up sort of regretting going down the line, right? And third, about volatility, right? Volatility is not something we can ignore anymore, or we can never ignore that concept in a market, right? It's part of normal functioning. But we are in an environment where earnings matter, valuations matter, capturing the right opportunities matter, and sentiments also shift very rapidly. So this means that investors should not build portfolios assuming that their entire investment journey is going to be very smooth, zero volatility. They're not going to have any trouble at all. They should build portfolios assuming a certain amount of uncertainty, temporary drawdowns, discomfort, and some stints of underperformance, whatever may be your risk appetite, right? Even if you are a conservative investor, you may want to see some level of, or you should be okay to see some level of drawdown, right? And this mindset itself can improve an investor's behavior over time, and that also very, very dramatically. Which is why we want to emphasize that you be a bottom-up investor in this market. Now, who's a bottom-up investor? Basically, someone who focuses on businesses, the quality of the management of the business, how the cash flows are, how well are they capturing market opportunities, and whether it's within our valuation comfort, right? So in a noisy market like this, especially, broad narratives and commentary tend to dominate headlines, but that's not how wealth is created, right? We create wealth by identifying those businesses that can survive the uncertainty and compound over time. That's the idea. So rather than asking yourself, what will the market do next? The better question is, which are the businesses or which are the funds that can create value across cycles, and what am I paying for them today? Am I paying a premium? Is it worth paying that premium? Will it help me in the long run? These are questions that you may want to ask yourself. It's not that every decision you make will be the right decision in your portfolio, right? But the sooner you realize that you have made a mistake, the better it is for you. Which brings me to explain this phase of uncertainty that we're in. So the best chart that I can show you here is the movement of the volatility index against our Nifty. So the chart, like I told you, compares the Nifty 50 and VIX, and the broad message is sort of clear that this is a market where there's going to be a lot of stress, volatility increases, etc. And the relationship between the Nifty and the VIX is inverse, right? So as market stress increases, of course, volatility increases, while the index, the direction of the index may become less stable and more sensitive to events. That's how you sort of interpret this. So the reason I want to dwell on this slide is because volatility is not just a metric or a statistic. It directly affects every investor's psychology, right? And rising volatility is always interpreted as fear, but from an investor behavior perspective, it's more useful to think of it as a measure of emotional pressure, right? So when volatility stays elevated, every news feels bigger for us, right? Even the smallest thing will come across as such a big news because of the amount of volatility that we are surrounded by. So because of this, every correction starts to feel like the start of something deeper or something better. We become sort of very baited in anticipation that we fail to see what is in front of us and what it can actually do for us, right? So investors become less anchored to the fundamentals and more anchored to the market environment, which is why they find the need to react immediately. And in that environment, even good portfolios can feel uncomfortable simply because of sharp price movements, right? But now one of the biggest mistakes that an investor can make in such a phase is to confuse uncertainty with permanent damage. I'm sure a lot of you here have done it. Maybe you can just raise your hands. Have you as investors thought that, okay, this is such a great phase of uncertainty and I don't know what I'm doing. So is my portfolio damaged forever? I've seen some loss, but I think my portfolio is damaged forever and there's no recovering from here. You can just quickly raise your hands or put a yes in the comment section. Any comments? Any of you who thought? Okay, great. If none of you thought that, then I'm extremely happy. But we should be aware that markets, of course, will go through such uncertainty at all times, right? We have elections, we have earnings resets, we have results, we have the war that's happening right now, right? So not every uncertain period destroys long-term wealth or does permanent damage to your wealth, right? In fact, many of these kind of scenarios are considered like the best long-term opportunities that are born during, these times, especially when confidence is low, the headlines are extremely noisy. And now what matters here is how we respond, how we as investors respond to these situations. So if we treat uncertainty as a reasonable, if we treat it as a reason to abandon and let go of disciplined investing, then that volatility can become very destructive for you, right? But if you treat it as a condition or a wicket to prepare for your batting, now then that volatility becomes manageable. And you're, of course, able to face any bowler, right? You're able to judge the bowler. And this is especially in a condition where the portfolio is constructed to weather this, right? Proper allocation to the right ideas, asset classes, diversification, and knowing your risk tolerance, that becomes very, very essential. So the real question is not whether uncertainty will come. Of course, it will come. But whether your portfolio and your behavior is designed to survive this volatility. So in a phase like this, of course, staying invested matters more than the timing. We always say that time in the market is more valuable than timing the market, right? We know that equity returns are non-linear and missing just a few of these best days can significantly reduce your long-term returns. And this is exactly what the chart on this slide shows you, right? That as you miss more of these best days, the ending portfolio value falls very sharp. Now, what makes this especially difficult is that many of those best days often come very close to the worst days. So how do you grab the opportunity? Or if I had to put it in simpler words, the periods where an investor feels the most uncomfortable are often the same periods where some of the strongest rebounds or corrections happen. So if an investor exits after panic comes in and waits for that confidence to come back before re-entering, then that investor is very, very likely to miss the most important part of recovery in his portfolio, right? Now, that's why timing the market sounds intelligent, very, very intelligent in theory, but very expensive in practice. And now for HNI investors, this issue becomes more pronounced. Why? Because the amounts involved, of course, are larger, and the temptation to protect capital becomes stronger. But here's what we should be very clear about, right? Protecting your wealth does not always mean avoiding volatility. Sometimes it means enduring that volatility to preserve it for long-term compounding. Now, selling after a correction may reduce immediate stress. That stress you have at the moment may go away. But if it also leads to you missing the recovery, then that decision can very, very strongly impact your return potential. So the lesson here is not that investors should blindly remain invested in anything and everything, but that if the portfolio is fundamentally sound and if it's aligned to your risk profile, the time horizon that you are looking at, then temporary volatility should not automatically trigger these exit decisions. Right? So every disciplined investor uses a phase of volatility to review his or her investments, rebalance, restructure, and not to just leave it aside at the worst possible moment. That's the worst thing you can do for your investments. So we are about to start seeing results. I think some of the results have already started coming in. We saw some of the pharma companies and auto companies as well. But what I would like to emphasize here is that results are not just about earnings. It's about resetting expectations, valuations, and investment behavior. Right? And earnings season is not only about whether a company beats or misses consensus. It's about how the market takes this into account and sort of puts across its future assumptions. So in a strong sort of momentum phase, investors start becoming very forgiving. They pay up for growth, they ignore temporary margin pressure, and they extend valuation multiples based on confidence. But in a more uncertain phase, that changes. That, of course, will change. The market becomes less generous to you. It starts asking you tougher questions. It tests your endurance. So is growth still sustainable? Are margins peaking? Is the commentary realistic? Are the valuations already discounted? And have they discounted too much of the optimism? Right? That's why result seasons can create sharp moves, even when the reported number may look attractive and reasonable on surface. So from a behavioral standpoint, result season usually can provoke reaction or sometimes even overreaction. So investors may see 1 weak quarter and assume that the story is done for. Or they may see one strong quarter and chase momentum without even evaluating whether expectations have already run too far. Right? So the better approach will be to use the result season to reassess the quality and reassess your portfolio and rebalance it. So that's why in a market, especially like this, the earnings data or the results data is not just a data point. It's their decision points, right? They influence expectations. They sort of set out to change narratives, and they reveal which investors are process driven versus sentimental. Now, this is what I want to focus on. This is like the heart of the webinar, right? The 4 behavioral traps, as you can see, are listed, right? Let's start with the first one, anchoring to recent highs. So this happens when an investor mentally fixes a company or a stock or index to its previous peak and treat that level as the correct value or the ideal value. So if, say, a stock has fallen from 100 to 75, the investor thinks of 100 as the normal and 75 as an opportunity, or sometimes a loss that must be reversed quick, right? But markets don't care about our anchor points. The relevant question is not where the price was, but what the business is worth today, right? So anchoring, this is actually anchoring bias, right? Anchoring usually causes investors to either hold onto poor businesses too long or to expect extremely unrealistic bounce backs, right? Simply because they are anchored to the previous high, right? And that translates into the second one, which is reacting to noise. Especially in this environment today that we are seeing in the markets, the amount of information is extremely overwhelming. And everything is trying to pull their investors' attention towards that piece of news almost immediately. But not every piece of information deserves action, right? In fact, like some of the most expensive decisions are made when investors respond to noise as if it was a signal. And that discipline is what lies in separating that temporary narrative turbulence from your genuine judgment of the change. And third is chasing recent winners. And see, this is actually, these traps are not just specific to HNIs. This is specific to any investor, right? And chasing recent winners as a trap is especially common after a phase where certain sectors of the market or market cap segments have drastically outperformed. And investors begin to extrapolate these returns into the future, of course, and assume that they will continue this performance because it worked well. But this leads to buying into overcrowded trades late in the cycle, especially at elevated valuations with expectations already fully priced in. But by the time the broader market participation arrives, the risk reward may have come down significantly for you. So there's no point in chasing those recent winners. You might as well focus your attention on looking at those that are actually presenting an opportunity. Because how are you supposed to, or rather, let me put it this way, you may not be able to tell for sure that what worked in the last cycle will definitely work in this cycle. Again, that boils down to time in the market versus timing the market. And the fourth trap is over-preferencing safety after pain, right? After a lot of losses, after multiple losses, many investors, they go to the other extreme. They don't wait or they don't want uncertainty. They don't want drawdowns. And they only want to put their money in those investments that feel safe. So naturally moving into FDs or liquid funds, debt funds, etc. Or maybe even holding excessive cash in their portfolios. But this might feel emotionally comforting for a while, but it can become extremely costly for you if the investor misses the long-term growth that is required to meet these objectives. So in a market like this, what is actually on an investor's mind? Right? When markets are weak or volatile or uneven, investors usually focus on what has not worked, and they basically look at their portfolios and see where underperformance has occurred the most and plan accordingly. So if at the same time they notice some other segment, say small or mid caps, has done much better, they start to build regret. They're like, why did I stay defensive into large caps while the mid and smalls looked better? Like even today, as I was working on some data, while the large cap valuations look relatively cheaper, flows continue, momentum continues to go into mid and small caps. Right? So the market is not taking opportunity of the defensive play that they need to. Right? So naturally, with all of this uncertainty, the question that comes to mind is, should I just stick to FDs? And this is not a foolish question at all, right? It's a very natural human question. It makes you feel much safer, especially after a difficult market phase. It becomes very attractive. But the problem is that investors compare the certainty of FDs with the temporary discomfort of equity markets without even trying to compare the return potential of this, or the goal matching capability rather. And hence, it is important that, how do I put it? Basically, safety as a measure should always be understood in relation to your objective, right? For example, if your objective is to beat inflation, then you should invest in those kind of funds. So if your objective requires real growth over inflation and time, then a full safety driven decision may probably not do the trick for you. Right? So what is really on investors' mind today is not just return, but confidence. So confidence in markets, in strategy allocation, and the ability to stay invested is what matters the most. And restoring that confidence requires, the right kind of advice, setting realistic expectations, and so on and so forth. And that's exactly what we did for our investors, right? So we offer 5 PMS products: Solitaire, which is our flexi cap strategy; True Blue, which is our large cap; Vriddhi, small and micro; Sphere and Neo are our multi-asset strategies. Neo is especially designed to cater to the NRI investors. Of course, we also did see drawdowns in our portfolio. It's not that we shy away from showing that we underperformed, but we have been able to sort of do better than the broader markets, capture the right opportunities, and actually even rebalance portfolio. So we exited ideas and moved that money into better ideas, and sort of tried and reduced the amount of negative impact that a portfolio may have. So the next few slides that I want to show you is just like how each of our PMS products has done in periods of crisis. So essentially showing you our drawdowns data. So most often than not, we have outperformed the broader benchmark itself, even during these crises, just barring a few, actually barring just one instance between 11th December and just 1 second. Yeah. Between 11th December 2024 and March 25, which was our tariff period. This was Sphere in Neo. Neo's inception happened in 2020, late 2022, so you may not see it in the first graph, but we have also tried and sort of outperform the broader market, which is the Nifty 50 in most conditions. This is True Blue. Apart from the war that we are going through now, we have managed to contain our drawdowns against the S&P BSE 500, and also with our small and micro cap strategy. Of course, the small and micro cap space is a little bit more risky than a defensive large cap or a flexi cap, where you have the flexibility to move between market caps. You may see more drawdowns, and Vriddhi as a product is for those investors who can weather these kind of volatilities. You guys must be aware of how the small and mid as a space itself has been very, very risky and is only momentum based. We don't run this product like that. We will see periods of underperformance. We will see periods of outperformance as well. But this is a product where you stay invested for 7+ years, right? That's when you actually start seeing results. Yeah. So now, what did we do for our investors in this market? One of the most productive things that we have been able to do, and we're so grateful that our investors have been able to do this as well, is contribute capital even in this market. And this does not mean that you blindly average in every fall, right? It means that you're using the periods of stress to improve your longer term entry points into quality opportunities. Now, that's where your guidance becomes very, very valuable. That's where an advisor really comes into play. Systematic investing, especially contributing fixed amounts every month, can be a very key thing here. And in this environment, maybe a large lump sum may feel a little intimidating, while nothing can come as a default reaction, right? And we were also very, very clear that we set realistic expectations, right? If we have told investors that, the next 12 to 18 months is going to be extremely, extremely difficult. And this is not a market where you expect returns. This is a market where you just stay invested and stay put, right? And this is very, very critical for any advisor to do for their investors. So, because investor disappointment does not come from, say, poor absolute outcomes, but from not matching their expectations, which may be a little unrealistic, right? So if an investor expects a straight line return from equity, they will always be dissatisfied during correction. So they'll see one spike down, they'll see one spike up, right? So as advisors, we constantly reminded our investors that this journey belongs to those portfolios that can stay invested. And this is not any sort of negative framing. We're just being honest, right? And that's what improves the power of staying invested in the product. And of course, given the volatility, we also pivoted to safer ideas and making asset allocation shifts. This is not a sign of panic. This is just being thoughtful and acting in the portfolio according to what the market is providing for us, right? This is being responsive rather. And no portfolio should remain static if the facts change, right? The changes should come from analysts. It should not come from emotion, right? And we also encouraged all our investors to review their portfolios, whether it was ours or their external, and maybe help them on what they could do better, how they can sort of restructure and redeploy capital, right? So external portfolio reviews and internal portfolio reviews became a very key part of our process, especially in this market. And of course, you should ask these questions before you invest anywhere, right? First and foremost being, does this investment fit my goal? Does it fit my risk appetite? Does it fit my time horizon? Because any sort of this mismatch is going to affect it. So a good strategy in the wrong hands can become a very, very bad experience, right? Second, what are the downside risks? Investors should spend a lot of time in understanding the return potential and less time in understanding the pain potential. They're often very informed about the return potential, but not so informed about the pain potential. But this also is essential, as in how much can this strategy fall? How much recovery, how much time can this recovery take? These are not like pessimistic questions that you ask. These are very necessary questions that you should be asking. And the final two questions, of course, are very, very important. You should also understand the fee structure. How much are they charging as fee? And any honest portfolio advisor would be very transparent about it, and that should be your cue to get advice from them. And the final two questions, etc., are what are the drivers of my returns and how long should I stay invested? So investors should know what is their ROI, right? Is the return expected to come from quality compounding, valuation re-rating, or any such reasons? And they should know the time frame that is required for them to stay invested to see these results. Right? So especially in a market like this, I'm sure a lot of our investors have come back to us saying, I've lost a lot of capital, but and we'll help you build a more structured and a strong portfolio that can weather all of these storms, right? And we'll help you build your financial comeback plan. We have a team that does this for you based on your goals, your risk appetite, and your timeline and your previous investments, right? You can always get in touch with us. This is the contact. You can make note of this and get in touch with us at any time. The team will be very, very happy to help you. I hope you've had an interesting session with us. Thank you so much for spending your 1 hour with us at ithought in this webinar. We hope to see you in upcoming webinars as well. And we also hope to help all of you start your investing journey or give you an investing experience with us. Thank you once again for joining us. I will see you again very soon. Thank you. Have a great weekend. Thank you.